on board Dinshaw Irani, CEO, Helios Mutual Fund, to talk to us about how he's looking at markets. Dinshaw, it's a fast evolving world. Gold continues to climb. $4,800 an ounce is where gold currently sits at. And it's a very, very uncertain world. How are you looking at the global macros? First, let's talk about that before we go domestic.
So thank you first of all for having me on your show, and a very good morning to
Great having you,
your team, and the viewers. Thank you. Anyway, so let's start with the global macros. Frankly, I mean, there's only one man who decides the next move in the markets or on the global front, and that's the President of the United States. The amount of uncertainty being talked about, I mean, Venezuela, Cuba, Greenland, and now one of the islands in the Mauritius, near the Mauritius and stuff like that. I mean, it's like really, I mean, one makes wonders where is this going to stop? And if it doesn't, obviously, the biggest hedge is going to be the precious metals. And that's why the rally that you're seeing in those precious metals, you can spin stories around them about user industries or whatever. But the fact is that the global uncertainty is proving to be so. But having said that, I don't think there's a major problem on the global front, unless action is taken by the person as such, I mean, to capture these islands and stuff like that. But apart from that, look at the US. I mean, fundamentally, fairly strong. Things are not as bad as being made out to. The dollar has, in fact, constantly depreciated against global currencies to an extent. Last year it did. This year it's holding firm. But that's good news for US in the sense that the overall debt will go down because of that in local currency terms. And obviously exports become much more exciting for them. So that's on that. And obviously on the EU front, I think Europe is doing a good job in terms of growth per se. So I don't see a problem with the global front. However, as I said, lots of uncertainties around. So better to avoid global markets as of now.
Okay, so Dinshaw, hi morning. That brings our focus back to the domestic market. Tell us, how should investors and viewers be navigating a market as volatile as ours, given the cuts that we've seen off late? Of course, there's always that 1% uncertainty, that chance of the taco trade playing out. But what impact could that have back home, and how does one just watch the market right now, given the kind of pressure that we're seeing?
Actually, it's hardly volatile. It's one side down. So it's not volatile. So it's not volatile. But the fact is that look at the globe. I mean, look at the domestic macros, right? We talked about global macros. Look at the domestic macros. I don't think they're on the way down. In fact, if anything, they're on the way up as such. And that's why our belief is that whatever is happening today is probably not the right way the market should be represented, and because obviously there's a lot of foreign selling, even in the domestic front. Apart from the MFs who are sitting on a lot of cash, and we seeing a lot of flows also actually on a daily basis. I think it's mainly the HNI crowd or UHNI crowd which has been hurt by the drop in small caps, and they've really been, I think, hurt there. So that's why that selling continues from that end rather than on the retail end. Retail is fairly firm. So having said that, I think that this budget, normally a budget is a non-event exercise. But I think this time around, this budget should do something at least for the markets. And the best thing that they can do is on the central front is take away the long-term capital gains for all participants in the market, because ultimately you want your markets to be stable. So that doesn't make sense having long-term capital gains in place. Probably you can increase the tenor in terms of the short-term gains, or even for that matter, if you want to neutralize this impact of long-term capital gains going away, you can increase STT on the players as such who are participating. That's a regular addition to the coffers of the government. So I think that makes a lot of sense. But probably, I think something has to be done. Hopefully, the budget will not concentrate as much on the deficit today. I think they should increase the expenditure on the capex front, spend a lot on fixed asset formations and stuff like that. I think that should also help the market in a way, by way of increased government expenditure. So I think this budget is going to be fairly well watched, not only by us in India, but also globally.
Dinshaw, you clearly seem positive where Indian markets are concerned, and maybe not in the near term, but at least the impression that I'm getting is you're positive for the next 2 years where markets is concerned, where we are currently at, especially given the kind of correction we've seen, 3% odd in the month of January itself, that you believe seem to be an opportunity. Talk to us about what this means, or where is it that you're more positive on, the larger caps or the mid and small caps? Because the mid and small caps have seen more pain. So some of the nifty returns are not getting priced on your portfolio. And therefore, I'm trying to get a sense as to, is there a better case for mid and small caps over the next 2 years?
So I talked about the macros, and actually the micros also are improving in India. I mean, what happened in last year, the whole of last year, and probably starting from the end of the 24, was that it was a total central and the RBI push to have fiscal loosening actually. But they were reversing what they'd done earlier to get growth back. And that actually one saw in the September quarter. The September quarter was fairly exciting, though it was coming off a low base. But mind you, I mean, why I'm saying low basis, because September of 24 was a negative growth quarter in terms of earnings. But if you go into the next 3 quarters also, like the December 24 quarter or the March 25 or the June 25 quarters, they were all flattish quarters. So we have a lovely base laid out to show YOY growth to the world. And that's what happened in the September quarter. We show almost a 15% growth. But if you were to break down, I mean, talking about 15% growth, I'm talking about the NSE 500, which is the most diversified index that India has to offer. But if you were to break down that growth within the 100, NSE 100, the 150 mid caps, 100 is the large caps, 150 mid caps, and the small caps 250, the growth rates there for the large caps was some 10% in earnings. For the mid caps, it was some 25 or 26% in earnings. And for the small cap, it was 37% in earnings. And I don't have any doubts that going into this December quarter, which is getting reported now, or for that matter, the March quarter, since I already pointed out the base has been low, the growth will be far more exciting in these two segments than in the large caps. So my feel is that once the skepticism is out of the way, I think these are the two segments that should do well, far better than the large cap segment as such.
And what within the mid small cap cohort, would it be some defense names? Would it be PSU banks? Would it be the likes of real estate? How should one play it?
So basically, we are very gung-ho about the domestic consumption space. I don't think the export-driven the stocks which are driven by export earnings, I think that should be taking a backseat today, mainly because of, as I said, global uncertainty globally. I mean, nobody's clear about how it's going to go forward. But our feel is that the domestic consumption story should play out to the core. And that's why we are focused more on the domestic consumption focused companies. And that also extends to banking, mainly the consumer facing banks, which are mostly in the private sector. One public sector bank is there, SBI, which we own, and I won't disclose that also. But apart from that, there's not many PSUs who are focused on retail. The NBFC space looks very exciting. Consumer-facing NBFC or the financiers, even of not only the pure consumption, but also like automobiles and so on and so forth. So I think those are going to really benefit, because the year before they were suffering because of low liquidity in the system and obviously higher rate of borrowing, which is now reversed for them. So they are fairly nimble enough to expand the NIMs going forward. So that's why we're more convinced on those stocks. Insurance, mainly health and life, is where we think the focus should be. Wealth managers, the mutual funds and stuff like that, AMCs and all. I think those are also good bets in the BFSI space. Even before, I mean, after that, obviously, we're talking about the new age companies, the consumer tech companies, if you will, if you want to call them, the platform companies. I think the exponential growth out there will continue, though they have exponential valuations, but they have exponential growth behind that valuation to support that. So I think that will continue to grow. Healthcare will continue to grow, and specifically hospitals within that. Hospitality is a space we like. Wherever there's discretionary spends, high ticket discretionary spends is the space that we like. So that's
Okay, Dinshaw, you've touched upon a bunch of sectors. Share with us your view. Pardon me, share with us your view on the metal space, given that it's not only precious metals but also base metals like copper that have also seen a significant surge. Should one continue to be bullish on the metal space given the run up that we've already seen, but also bearing in mind the fact that some of these are safe haven commodities?
So basically, on the metal space, we never used to like ferrous metals because of the kind of clout that China has in that space. In the non-ferrous space, also, we were fairly clear on which segments we wanted, but we stayed away because today what's happening is China is holding back its capacities from the global markets per se. I think basically they're also trying to play a geopolitical game by increasing the commodity cost. So I think going forward, whenever China decides, it's their benevolence today, whenever they decide to release those capacities, I think things will be not that gung ho going forward in the non-ferrous space too. So that's why we are staying away from that space today. But however, I mean, it's individuals' call. That one anyway, we never like cyclical kind of place, so we always have been away.
And Dinshaw, the ultimate question: the smartest investors in India at this point have been the housewives, if I can call it that. All of the gold that they've stocked up over the many years, they've outperformed equities by a mile, at least over the last couple of decades. What next, in your opinion, for gold and silver?
The call is all over the place. So basically, as I said, that gold, I think both gold and silver both, uh, whenever there's uncertainty in the world, they always are a safe haven to get into. However, one thing I want to highlight out here, I say joking to all the guys who say that India's wealth has gone up because of the kind of gold that the housewives have stocked in the houses. And I always tell them that try and tell your wife that I want to sell your necklace and buy a car and see what ruckus is causing now. So this is purely a wealth effect which is within our hearts and nothing beyond that. So we're not going to come out in the open. So that way. But anyway, as I said, that no bets on the precious metals per se.
Okay. All right, Dinshaw, it's always a pleasure speaking with you. So thank you so much for taking our time and giving us those views. Of course, we've covered a whole host of factors which are likely to play out over the next month, including the budget and including what he feels of mid, small versus large. Thanks, Dinshaw, for coming in. Let's now go across. We have